Hi, Dominique, and welcome to another edition of the week ahead. And as we always like to do, we kind of have a recap of the, I guess, kind of market actions, kind of any market moving stories from the past week. Obviously, equities are not having a great run in the last week, as well as the dollar is having a pretty good run. And then, as the narrative around inflation is continuing to move towards your and higher rates continuing to move towards kind of your view. As we've seen, some of these, Mark Mobius came out trying to outdo you as saying Fed funds rates would have to go to 9%.
I was there first.
What? You were there? Yes. It made me think of this funny thing from a movie, something about Mary, when it's about like the 7-minute abs, and the guy's like, there was a thing talking about get into shape in just 8 minutes, and there's a joke, and the guy comes up, he goes, I got something better than 8-minute abs, 7-minute abs. So he just outdid you by one. But it's been amazing. You've been clear even when everyone said the US is in a deep recession already, and clearly, I mean, most of the data seems to be accelerating, which, including myself, thought was kind of crazy when you said that stuff. So first, let's recap, kind of what your thoughts are from the past week.
So the CPI obviously was a big event, and for me, what is satisfying is that it got higher. It not only got higher, but for the reasons I expected. So it's never a good thing to be too confident in your own narrative or your models and so on and so forth. But this comes after 2 months of a soft CPI, so I was of course quite pleased. But yeah. I mean, the macro story hasn't changed, and the problems are becoming more apparent. The Fed is not managing to slow the economy. They are struggling to tighten financial conditions. They've completely underestimated the extent of the tightening that's going to be needed. And for instance, one of the things we are seeing at the moment is inflation expectations moving down and actual inflation moving up, which is basically, falsifying the Fed model of inflation. As long as inflation expectations are stable, inflation will be self-stabilizing. Obviously, that's not true. And at some point, they will have to, confront stop ignoring the evidence. So, I mean,
what can they do different? Because it feels like 75, let's just say they continue at 75, that feels like a pretty good pace, like where they give enough leeway not to, if something does crack, and they continue on this pace. So we all agree that not just last year, but probably for the last 8 to 10 years. I mean, to me, I still point to one of the worst things I thought, and obviously there's other stuff, was that they cut 3 times kind of after 18, which, like, cutting once was fine. The market stabilized and like growth was strong, and they cut 2 or 3 more times. Which was a terrible call, obviously. I still think that a lot of the problems in the world is not just the Fed. I mean, Europe to hold interest rates at deeply negative for so long, like, of course, there's going to be some bad things that result, and maybe this is how we're seeing everything play out, but not defending them. But yeah, so were you surprised about the market's reaction? So yes, I think your point that it broadened out so deeply, inflation, that really spooked markets, especially so many people that were assuming we're on the way down, and then it's just a question of how fast.
Exactly. And it's not over, because the next thing that's going to hit us, and this is where the Fed and the markets are really going to panic, it's an acceleration in wage inflation. And I think it's only a matter of time, because you saw the railway strike that was avoided last week. It was avoided through a 24% wage increase, I mean, over 5 years. But I mean, basically, American workers have been underpaid for decades. And now, with the labor market so tight, it's their day. And we're seeing strike left, right, and center. And also people not going back to work until they get paid more. So I think the next thing that's really going to spook people is when we move away from this about 7% year-on-year increase in wages, which is what the Atlanta Fed median wage is showing us. I think it's only a matter of time. It's just like the CPI. I cannot predict, whether it's going to be this NFP, the next NFP, because the monthly data is very noisy. But the macro environment is there. So that, I think, is also going to make the Fed think a little bit about, how fast can it go. So what else could they do? I actually think they can't, there is a limit, so they can do 1%. But there is a little bit of a limit on how much they can do at each meeting.
Yeah.
And if they agreed with me, because there is the risk of spooking the market. There are some very serious issues in the treasury market. Like, for instance, if the repo market is a very key pipe, and if you look at the ratio of outstanding repo to outstanding treasuries, it's collapsed since the crisis. So liquidity has come down. We have piping issues. In my view, that puts a speed limit on how fast they can hike rates. Also, the thing central banks hate even more than inflation is being proven wrong. So hiking very fast would be an implicit admission.
Yeah.
They've been behind the curve for such a long time. So it's a big pickle, and we're not getting any out of it anytime soon.
Yeah. We are still in a global economy, and it may not be in the US, it may, like, the real kind of fractures next to come could just be in emerging markets.
And in the Eurozone.
Yeah, which we've talked about in the past, especially Asia, a lot of Asian corporates, especially China, have dollar-denominated debt. Now, totally. I always kind of thought about it as the fact that, dollar China doesn't really move. Okay, it's moving, it's weakening a little bit, the Chinese currency, but it's small. But the problem is that if they tap the market and they're relatively high yield, and they tap the market in the past at 6-7%, now they have to tap the market at 10-11, like, that's not great for your business. And if you're in a commodity is an important input, or energy is an important input, I mean, all this stuff together, I feel like emerging markets is really the next place that we may really see if the Fed continues to move at this pace. But yeah, so far, you've been absolutely right. I just don't know. I guess,
about emerging markets. I mean, one factory that was really interesting, how China and the US are really not in good terms. And yet the Chinese gave in to US demand to allow US auditors to inspect the books of Chinese companies listed in the US. And that conflict has been simmering for years.
It's like a Congress is,
Why did the Chinese agree, given, that they want the renminbi to take over from the dollar and so on? So I think they have agreed for practical reasons. They need their companies to be able to refinance their dollar debts. And so that's probably why they made the concession. So I'm 100% with you. The next domino to fall are going to be the large dollar indebted EM corporates. Chinese property developers probably top of that list because, you know, they get revenue in local currency and they borrow in dollars. Best trade ever. So that always comes back to
Yeah, but this wage spiral is really like this is the real issue right now, it seems like. And so what slows it? So eventually, let's say Fed gets to 7%. At some point, enough businesses will say, there's too much uncertainty, I'm not going to hire anyone else. And then that snowballs. I may even have to let people go. Okay, I guess that's got to be it. Because most often businesses need debt to financing to expand. Now, some of it is just going back to where stuff was in 18 or 19. But some of it is expanding and, you know, and there's opportunities and hiring people. So yeah, I mean, I guess eventually that will slow down the wage spiral. And then your other point, I guess, is it eventually will also be attractive enough, or people's situations will be worse enough that they will accept, one, they will start working again, and two, they will accept wages that are not significantly higher. And that's how eventually this slows down. But as a lot of people said, you included and Bilal included, just be like all the deflationary forces that have been present in the last 15 years, most of them are reversing. So the Fed also is just in a bad position now. Now we can debate that they've partly and other central banks caused all this, but it is what it is right now. So I think we all agree, like getting inflation back down to 2%, this could be a long journey. Now talking it through, I can really understand how we may get to 8%. By the way, at 5%, even myself, who I never really owned any fixed income, is now saying, oh, you know what? It's putting my money in a 1-year CD at 4% doesn't sound that bad.
Yeah, but see the issue, so definitely, but the issue there is the transmission of the 5%. And in the US, the rate that really matters for business and household loans, especially mortgages, is a 10-year. And so we have curve inversion, which is really making, at the moment, which is getting deeper and making life more difficult for the Fed because they are pumping the brakes as hard as they can, but the car is not stopping. It doesn't get transmitted to the economy.
Yeah, and even looks like even like high yield and stuff is not blowing out.
Exactly. So one of the feedback I've been getting from just about every customer about my 8%, so it will trigger a systemic financial event. And the more I think about it, the more it seems likely. Though if you look at past episodes of crisis, think about GFC, for instance, the crisis happens after the Fed funds has reached the terminal rate. So we probably get the recession, and then the recession will reveal fragilities. And so within the team, we've spent a lot of time trying to think, where are the fragilities? So as you said, EMs is one. In my view, the Eurozone is going to be also in deep trouble. I can't see, how it's going to be possible to stabilize Eurozone inflation and keep periphery countries, Italy especially. You have to realize real per capita income in Italy right now is lower than before they joined the Eurozone in 1999. So this is a country that, by contrast with Spain, for instance, has never been able to capitalize on the euro area. And these things take time, but eventually they come back through the political process. so that's, that's another one. And the story, by the way, about their inflation is mostly goods and services. I think it's irrelevant because once inflation crosses a threshold, wages adjust, and then you get transmission from food and energy to broad-based inflation. And given that labor markets, even in the Eurozone, are tight, it's only a matter of time. They are just lagging the US. But in the US itself, it's a little bit of a mystery where the hit is going to be. Banks' balance sheet look great, though, I have some questions. The curve is inverted. It's not great. The quality of credit is going to worsen. At the moment, we have extremely fast growth in household and corporate credits from banks. If we have a recession, the quality of the bank's book is going to go down. So banks, despite this over-tightening of regulation, could still be exposed.
The banks are clearly, stock prices are showing that there's some issues, and now they've been announcing the fact that deal making, so investment banking fees, are gone down significantly. And then I think a lot of banks have a lot of exposure to private equity and private equity deals. I don't know how massive that is. And then there's other things we also talked about, and it's not a small sector, the kind of used car market and how much finance has gone into that at very elevated prices. And now as these bottlenecks come unwound, and if people do have issues, the lower end, usually lower end credit score, that could be another big issue, which people have been, I think is probably an issue. But so far, the lower end is who is getting raises. Now, again, lower end is probably mostly the most impacted by inflation as well. So, okay, so let's move ahead to a big week coming up. So, yeah, what's the most important things this coming week?
My favorite thing, the Fed. So I think they're 75. I don't see them doing 1%. They just don't have the consensus. They don't want to look panicked. And they are still, and that's one of the things I will be looking for in Powell's press conference. I'm hoping for good questions, because I'd like to know if, for instance, Powell still believes that stable inflation expectation means that everything is fine. And he's given some hints that he's having second thoughts on that. So that's definitely one of the things I'd like to get a sense of. Then you have this debate, which is not really in the open, but obviously happening behind the scene, which I mentioned in one of my shorter pieces about extending the period of convergence of inflation to the target in order to limit the cost in terms of employment. I mean, there was this conference at the Brookings where some very credible economists saw the cost being unemployment above 6% for a couple of years, and this was under fairly optimistic assumptions. So I'm sure there is this debate. In fact, if you listen carefully to what Brainard has been saying, she kind of hinted that, as long as inflation expectations remain stable, it will take what it will take to go back to target, which, made me a bit uneasy.
Right. And why are expectations why have they come down so much?
Because they are linked to oil prices. And also because, in terms of inflation, what's really important of expectation is whether expectations of inflation are changing people's behavior or not. So you have a sort of threshold effect here. And the idea is that you can measure expectation to the decimal point, to the first decimal point. It's nuts. It makes no sense. The only people who have, such precise inflation expectations are not even you and I. They are the University of Michigan survey responders And the same with the conference board. Well, the University of Michigan. And then you have, and then you have BE, but BE, it's market data, break evens, they are driven by all kinds of things. 99.9% of the American population has no idea what a break-even rate is. So it makes no sense. And it's one of the reasons the Fed has been so, has been so far behind the curve. That
and fairly confident about this. Soft landing. Yeah.
The transitory. So one thing that could happen at the meeting, which could generate a bit of market reaction, but in my view is not the main event. So the Fed has given up on forward guidance on purpose. They told us, Waller said so explicitly. Okay, so no more guidance about the meetings, but then what about the dot plot, which is a form of forward guidance? So the Fed is rumored to have been, trying to get rid of the dot plot for years, and now would be a good time to do that.
Did that spook the market or no?
Well, yeah, but you see, one of the problems that the Fed has is that they need tighter financial conditions.
Yeah.
If you look at the financial condition index, for instance, Goldman, on your screen, it's been in the same range for about 4 months, and so they actually need weaker financial markets. And I'm not sure how much of a reaction it would elicit. Because, I mean, by this stage, we've seen forward guidance for what it is. I mean, the Fed doesn't have any better ideas than we do on what's coming next. So
maybe worse, by the way.
Worse.
To some of your,
So I think the thing that would spook market if they let go of the Fed, of the dot plot, is that it would be another sign that the Fed no longer has a back of market. So it wouldn't be the loss of information, because there was very little information there. Rather, it would be another nail in the coffin of the Fed put. So that's where, and that's why I think the reaction could be negative, but probably not long lasting.
Not huge thing, yeah. Okay, cool. What any data and stuff that people should look out for?
Sure. So this is a big residential real estate week. We'll get starts. We'll get existing home sale permits. The NAHB indices, markets all expect them to be down, which is very reasonable. But again, I think people are overestimating the impact of the real estate market weaknesses on inflation and on growth, on GDP. Real estate investment is about 3.5 percentage points of GDP. So and in fact, it's been contracting for the past, since the beginning of the year. But, even if it goes down by 10%, so this is going to show my number literacy, 10% of 3.5% is what? It's 35 basis points. I mean, the biggie in the national account is consumption. This is really what we need to look at. And consumption is doing very well. And what is really fascinating is that household wealth took a hit in the second quarter, but consumption, real consumption has continued, which, by the way, is consistent with the data. And I wrote about this a couple of months back, but it's consistent with everything we've seen since the GFC. Household wealth has much less influence on household consumption. So we have employment growth around 4% a year. With the decline in headline inflation, we've had, positive real wage growth. We have falling savings rates. Wow, the US economy is going to do very well.
Okay. Anything else people should be looking out for next week, or?
We are going to hear noises about government funding, but it's it's a ritual. It's a little dance we get at the end of each financial year. If you're interested, you can look at my calendar. I give a bit of the background, but the bottom line is we have an election that is going to be really crucial for Democrats and Republicans. Neither side will want to be seen as responsible for shutting down the government. So, you know, I'm mentioning this, but you can largely ignore it as a background noise, basically.
Yeah. Okay. Okay, cool. Well, thank you.
Thank you.
Yeah, thank you for, and you know, all your great insights and sticking to your views. And I guess, you know, we say like, you know, for our clients who push back on a lot of stuff over the last couple months, like, that's great. I mean, I think all good researchers want people to challenge their view.
Totally.
You know?
So,
and you always say that, you know, which is great. You know,
I get my best ideas when people contradict me, and sometimes they're right, you know. So
exactly.
Hopefully not too often, but so.
Exactly.
Any objections or strong feeling will be very gratefully received.
Yeah, cool. All right. Well, have a wonderful rest of the weekend, and good luck to all our investors and clients and just general viewers, I guess, for this coming week, and obviously the Fed week. Hopefully that it all goes well.
Good luck to everybody.
Okay.
Take
Bye.
care. Bye.